This is 1A. I'm Indira Lakshmanan in for Joshua Johnson. Thanks for joining us. 10 years ago, the U.S. experienced its worst financial crisis since the Great Depression. Massive home foreclosures, a global debt and banking crisis, and costly government bailouts. The U.S. government responded in 2010 by enacting the Dodd-Frank Wall Street Reform and Consumer Protection Act, a series of measures intended to promote accountability in our financial system. House Republicans are now pushing an alternative called the Financial Choice Act that would roll back significant aspects of Dodd-Frank. What could these potential changes mean for banks and for consumers? With us to discuss is Congressman Jeb Hensarling of Texas. He's the chairman of the House Financial Services Committee, and he's the author of the Financial Choice Act. Congressman Hensarling, welcome to 1A.
Indira, thanks for having me.
Well, we're delighted to have you, sir. So first, begin by telling us, what is the Financial Choice Act?
Well, it is a bill that is designed to promote greater economic growth and to assure that we have no further bank bailouts. The problem is that on Dodd-Frank, the promises that were made were not kept. We were told that Dodd-Frank would lift the economy, and instead, we continue to be stuck in the slowest, weakest recovery in the post-war era. Middle-income America hasn't had a pay increase in a decade, and the savings still haven't recovered. We were told that Dodd-Frank would make our economy more stable, but instead, the big banks are bigger. The small banks are fewer. We're losing a community bank a day, so that's the second promise that wasn't kept. The third promise was we were told that it would end bank bailouts. Quite the opposite. What Dodd-Frank did is it codified bailouts into law, allowing the FDIC to potentially borrow trillions of dollars from the U.S. Treasury to do AIG, like bank bailouts, where foreign banks can get 100 cents on the dollar. Finally, Dodd-Frank promised us that it would help the consumers, but since Dodd-Frank was enacted into law, free checking has been cut in half. Many bank fees have gone up. The ranks of the unbanked have increased. We have fewer credit cards. They cost more. Mortgages are harder to come by, and they cost hundreds of dollars more. So we can't sit still and do nothing. And so what the Financial Choice Act does, it simply says there's going to be a trade-off. If you have a strong balance sheet, think in terms, a good analogy is if you buy a privately financed insurance policy against failure and bailout, which we call a simple leverage ratio, having equity capital against assets, if you will do that, then you can essentially have a Dodd-Frank off-ramp. We believe that we should have greater simplicity, not complexity, that we should have bankruptcy for large financial institutions instead of bailouts. And we believe that private equity capital ought to substitute for taxpayer capital. At the end of the day, we think it will promote a healthier economy and a more stable financial system.
All right. Well, you've given us a lot of information just now, so let's break it down a bit. First of all, what is the concrete evidence in numbers that Dodd-Frank has suppressed the growth of earnings in American banks and earnings of ordinary American workers?
Well, again, middle-income America hasn't had a pay increase since Dodd-Frank.
But how do you correlate that to Dodd-Frank?
1.5% to 2% economic growth. Of all the regulations, Dodd-Frank has created more regulatory burden on our economy than all Obama-era regulations combined. That's according to the Mercatus Institute. And so we now talk to any small business person, and this is a huge problem in our economy. Entrepreneurship is at a generational low. It takes small banks to lend to small businesses, and we're losing a small community financial institution a day, either a community bank or a credit union. That is a fact. We've had almost no new bank charters since the advent of Dodd-Frank. Small business lending has not recovered since the advent of Dodd-Frank. That's the feeder stock to the economy. Again, we are languishing at 1.5% to 2% economic growth. It's mainly the regulatory burden on our economy. The chief regulatory burden is Dodd-Frank. 400 rules, 2,000 pages that has now spawned tens of thousands of pages of regulations that simply have hurt consumers and made the economy less stable and less prosperous.
Well, you cited the Mercatus Center at George Mason, which is, of course, a free market research institute. But we all know that the economy is multifactorial. So while you say that working Americans' incomes have not risen, how do we know that we should be pointing the finger specifically at Dodd-Frank as the fault?
I can also cite a University of Maryland study that says that Dodd-Frank has hurt small banks. I can cite a Harvard study as well, and I'd be glad to get you the citations.
All right. Well, overall, you basically have said that Dodd-Frank is a failure. Is there a number that you can attach to that in terms of the cost overall to the economy and the cost that you think you would be liberating if you were to cut it off?
Well, it's a fact, again, that historically our economy has grown in the post-war era 3 to 3.5%. That's simply average. And so what we know is since the advent of Dodd-Frank, the economy has grown 1.5 to 2%, and that is simply substandard and unacceptable to the American public. And again, you can look at the fact, and there's incredible anecdotal evidence by speaking to, for example, credit unions and community banks. They can't make loans that they were once able to make. Again, the statistics are that we have the lowest level of entrepreneurial activity in a generation as well. And so we believe the answer is to tell our financial institutions, if you will have a strong balance sheet, what we require in our bill is 10% equity capital. According to the FDIC, 98% of all financial institutions that had 10% equity capital against assets survived the second worst financial crisis in America's history, 98%. And so we simply believe that we should require far more capital than is required by Dodd-Frank. And frankly, in our bill, we also have the strongest penalties for wrongdoing on Wall Street, be it theft, be it deception, be it insider trading. Far stronger penalties than are required by Dodd-Frank. But at the end of the day, we believe in free enterprise. We believe in competition. Competition is the consumer's best friend and the best form of consumer protection.
So, Representative Hensarling, let me ask you, you mentioned what you felt were substandard rates of GDP growth. How much of that is a hangover effect from the fact that we had the greatest recession and economic crisis since the Great Depression?
Well, according to economic history, the answer is none. If you look in the post-war era, quite the opposite. The deeper the recession, the quicker the rebound. And particularly this is true in the recession of 1982-83, where we actually had a greater GDP contraction and greater levels of unemployment. Yet the bounce back was so much quicker. Why? Frankly, public policy. We have had bad public policy under Obamonomics, of which Dodd-Frank is the key pillar. And so that has kept the economy from growing. If you will look at almost every single other recession in the post-war era, you will see a far greater snapback than what you have seen here.
All right. Let me ask you, in your financial choice bill, you wanted to repeal the cap on what banks can charge retailers when consumers use their debit cards. But you did not have the votes. And the news has just come out that measure was holding up the rest of the bill, and now it's being abandoned. What's your reaction to that?
Well, I'm the guy who's pulling it from the bill. So I can perform simple math. I am one vote out of 435 in the House. I made my case. The votes weren't there, so we're going to move on.
All right. What happens to your bill now?
We expect to go to the full House in fairly short order, and I expect this to be passed by the full House, and I look forward to going to conference and seeing what kind of bill the Senate can produce to get America back to work, to end bailouts, and to promote economic growth.
All right. Well, one of the things you have on the chopping block is the Consumer Financial Protection Bureau. Senator Elizabeth Warren, who is, let's say, your nemesis on this issue, you know, the Bizarro to your Superman or the Batman to your Joker, depending on one's point of view, was the founder of this bureau. And she says this in its defense.
It has exactly one job, and that is to watch out for consumers and make sure that even the biggest, fanciest bank in this country has to follow the law when they're dealing with your family.
So what's your response that she says killing the CFPB hurts the little guy?
Well, it's not the first time that she has been wrong. There are approximately 24 major consumer protection laws that are on our books. We don't necessarily need a new government agency that is unaccountable to the American people, that runs afoul of due process and checks and balances, and at the end of the day has actually hurt consumers in many, many different ways to do that. And we also have a particular agency who has had a history of rampant accusations of racial and gender discrimination. We have an agency that has promulgated a rule called the Qualified Mortgage Rule that, when fully implemented, according to the Federal Reserve, 1/3 of all blacks and Hispanics who qualified for a mortgage just a few short years ago would no longer qualify. We have an agency here who was totally asleep at the wheel when it came to Wells Fargo and just swooped in for a headline fine, but did none of the work. And so when she says they only have one job, well, the truth is they're not doing that job very well. And in the land of the free and the home of the brave, one unelected individual should not have the power to decide what credit cards we put in our wallet, what mortgages we have on our home. You just can't believe in democracy and believe that you ought to have essentially a benign dictatorship.
Representative Jeb Hensarling of Texas, thank you so much for joining us.